Hello and welcome to Built In, the FMI podcast for the built environment. I'm Scott Winstead, president of FMI Consulting. I'm really excited about my conversation today with Russ Becker, CEO of API Group, number 5 on ENR's most recent list of top specialty contracting firms. Having recently eclipsed the $6.5 billion a year revenue mark for fiscal year 2022, API epitomizes what it means to successfully build a company through acquisitions. Well, Russ, thanks so much for agreeing to do the podcast. Welcome to the show.
Super fired up to be here, Scott.
And likewise, Russ. So 90 acquisitions, 500 locations, $6.5 billion in revenue and growing. I'm really excited about our conversation. We're going to obviously talk a lot about acquisitions. I'm sure we'll get into a number of different areas. But before we get too far, do you mind starting us off with a brief overview of API Group?
Sure. Like you said, roughly $6.5 billion in sales. We divide the business into 2 segments. First would be what we call safety services. That's where our life safety and security businesses make their home, as well as our HVAC services companies. And that's roughly 2/3 of our revenue. And the other third comes from what we call specialty services, which are businesses that are more acyclical in nature, focused on infrastructure, telecom, industrial maintenance services type opportunities that those businesses see. Our business has traditionally been centered in North America. Really January 1st of 2021, we made a transformational acquisition of the Chubb Fire and Security business, which is at the time was roughly a $2.2 billion firm that was based in London, and with businesses in 20 different countries around the world. So for a company like ours, who was primarily focused on North America, we had very small European operations before the Chubb acquisition. Really was a transformational opportunity for the company, and something that we're very, very excited about having our Chubb teammates as part of the API family. So the business, really has grown both organically and through acquisition, over the course of the last 20 years. It traces its roots. We've got companies that were founded in the early 1900s. The original company was the Reuben L. Anderson Cherney mechanical contracting firm that traces its roots back to 1926. And we've got acquisitions that go back even further than that. And so the company has a long heritage, long lineage, and it's really been growing and evolving since. I think the one thing that's probably one of our largest differentiators is the company's core purpose. And our core purpose is building great leaders. And, when an organization has as many branch locations and operating companies and in businesses, leadership is essential to your long-term success and vitality. And I think we figured that out back in the early 2000s when we really started our journey of leader development in 2003. And I think that's made a fundamental difference in our business, and I think differentiated us from our peers in the space.
So Russ, how have you baked API's purpose into the DNA versus having it be a tagline as we see with so many other companies?
It really is what defines our company's culture. And it wasn't necessarily that way when we really started our journey back in 2003. When we started in 2003, we literally just started. And it was the first time we sent some folks to the Leadership Institute, which is a learning opportunity that's obviously hosted by FMI. And we started having leader labs. And we have our leader labs were simply one in the spring and one in the fall. And it's a day and a half of people getting together, really like the afternoon of a Tuesday with a dinner that night, in the morning of a Wednesday through noon, we feed you lunch and send you home. And I think one of the things that makes our leader labs a little bit unique is we spend 100% of our time on leadership development. And there's no spreadsheets, there's no talking about business results. We're going to spend that time on ourselves as individuals and leaders and coaches and mentors, and trying to be the best people that we can possibly be. And when we first started those events, FMI facilitated them. And we just kind of have kept on building and adding and building and adding over time. And, I'd say today, I bet you we've sent I'm guessing on this, but I would guess that we've sent 2,500 people to the Leadership Institute. Corporate pays for the tuition for everybody. The company's responsibility is to just get the person there. And what that has done for us is it's created a kind of a common foundation for everybody to work from. It's created a common vocabulary. So when people are talking about flywheel and those types of things, everybody, really understands what do we mean by that. And it's been true. It truly has been foundational for the company. And as we continue to acquire new companies or hire new people, one of the things that right away goes on their individual development plans is attend the Leadership Institute. And I think that it's been something that's been very good for us. And as you know, we basically were a huge part of the creation of the Field Leadership Institute, and still buy out the Field Leadership Institute. I think it's 3 times a year where we send, only API field leaders to that. And personally, I think that the investment that we're making in the men and the women in the field is a differentiator for us from our competitors and peers. I also think that if we're going to really move the needle from a business performance perspective, investing in those folks is something that's super important to us. But, if you look at it, I think we're probably spending north of $6 million a year just on leadership development. And it really is kind of the glue that binds our organization together.
You mentioned something that I think is really important about the focus on the field and field leaders, the men and women who are out there. And it's always been fascinating for us to think about it. So many firms focus on overhead and how do we tighten the screws and how do we lower overhead. If you think about it, 80 to 95 cents on every dollar that runs through any type of construction business, whether it's self-performing specialty trade or GCCM, 80 to 95 cents are driven. The results are driven by the decisions and the activities of the folks that are in the field. So those field leaders really control the destiny, as you said, from a business performance, yet the investment in those folks hasn't really kept up. You kind of touched on this. I'd love your take on when you are talking with potential candidates to acquire them and to make them part of the API family. To what level does your commitment to leader development become part of the elevator pitch to them, the value proposition to them to come on board?
A meeting one. We look at M&A through really 2 different buckets now that we're a publicly traded company. First is transformational M&As, that would be transactions that are like the Chubb Fire and Security acquisition that we made. That's more of a transaction. That's investment banker led. The price that you pay is going to be important. Terms are important, but you don't have the same opportunity to vet culture, values, and fit. But if you look at the more traditional M&A, whether that's buying a $10 million revenue company and bolting it onto one of our existing businesses, or buying a $100 million business that we would, have operate as a standalone inside one of our segments, culture, values, and fit is 100% the key to success, both for the seller as well as for us, who would be the buyer. And I learned, very early in my API career, going back to, the early 2000s, that if you don't get the culture, values, and fit component of it right, you're going to continue to struggle, with bringing that business and those folks into your family and feeling like you're part of the family. And so if somebody doesn't think that leadership development is the right thing for them or the right thing for their business, the chances of there being cultural alignment are probably pretty low. And, we really openly encourage potential acquisitions to vet us, just like, we want to vet them, and so that they make sure that it's the right fit. And the reality of it is, for us, is, we need to pay a fair price when we buy these companies. But if the seller is 100% focused on getting the highest price that they can possibly get for their business, they should go sell to private equity or to somebody else. And we're probably not the right fit for them. And so it's something that's really important to us. And, I feel like over the course of time, we've really done a good job of staying focused on culture, values, and fit.
It's a great point. And I've heard you say this before, but we don't buy fixer-uppers. And so as you think about culture, values, and fit, what does that look like when you go about vetting firms to come on board the platform? What does that look like?
Well, I mean, I think you spend time with them, right? We all have our little, I guess, nuances on how we do that and how we go about that. Like I love seeing people in social settings because I can see how they treat the wait staff or see how they treat the bartender or if they hold the door open for folks when they're going into a building. I like to see them take us on a tour, of their business during operating hours and how do they interact with the folks on their team, when they see them. You can tell right away whether they know the people or they don't know the people. I mean, you can just tell, and I can tell so much by just walking through a business. I can tell if they cleaned up for us or this is just normal operating. You can tell a lot. You go out into most of these businesses are kind of office warehouse, where they have the office in the front and the warehouse operation in the back. I always go into the warehouse. Is it a mess? Or is it really organized? And so all of those things can give you, I mean, the math is the math. It's not that hard. I mean, if you're going to try to put a value on a business, give me a copy of their last 3 years financial statements and a current balance sheet. And in 10 minutes, I can tell you what I'd pay for the thing. It's vetting the business for that fit. And that just takes time and spending with people. I mean, I feel like over the course of the last 20 years, I feel like we missed on fit one time. And I still kick myself in the backside every day for it. I more or less delegated that whole kind of vetting process. And obviously I can't vet every individual transaction that we do. But in this particular case, 3 days before the deal closed, I flew out and had dinner with the guy and didn't really spend any time with him. And he slipped by. And I mean, out of all the deals we've done, I feel like that's pretty good track record in general. But still, I think that if we would have done the right level of homework, it wouldn't have happened to us.
I'd say 80 plus versus one is is a pretty good track record. You mentioned something I think is really interesting. So the math is the math. Curious how much of your deal team's energy is focused on managing the psychology and the emotion of the seller or the firm getting acquired versus kind of the math, the EBITDA, the earnouts.
I actually, Scott, think that that's something that I give our team a lot of credit for, right? I think that they've realized over time that, we're doing deals all the time and the seller is probably going to do it one time in their life.
Right.
And to me, that's a strength. And, building trust is something that's, really important. And, the world that we fish in is pretty small. And, word's going to get around if you don't treat people, what I always say is fairly. If we're going to ask a seller to take risk on something, we should be willing to give them upside. I mean, the gate needs to swing both ways in these types of deals. And it's not about winning a negotiation. Your chances of winning a negotiation, if you really wanted to, would probably be pretty high, but that's not going to make, that individual seller feel very good, on the other side of it. And, you need to treat people fair. And I've always said this, if we tell somebody that we're going to do something, I don't care what the lawyers come up with, we're going to do what we said we would do. And I think it's a testament to, how we treat people is a testament to the fact that, like a gentleman like Steve Ulmer, we bought Davis Ulmer, which is a life safety business. We bought that company, I don't even know, 16 years ago. And Steve Ulmer is still working for us. His role's changed and evolved, and I think he's doing stuff that he finds that he has more fun with. Paul Gruno, we bought his company 15 or 16 years ago. He's still working for us. And I think that that's just a testament to how we treat people. It's the fact that we, really spend the time getting to know people and, we invite really good people to join the API family. And I think it all works kind of in concert with each other.
I mean, those are great testimonials and examples of walking the talk. The first thing that came up for me is the perspective that short-term easy is long-term hard, and that winning the deal might feel good in the moment, but the long-term residual impact might not yield the impact you're looking for. Curious, having said that, how often do you encounter sellers that have unrealistic valuation expectations?
All the time.
I figured that would be the answer. So it was a little bit of a layup, but how do you manage through the process of closing that gap in expectations?
Well, I think really all you can do is just have a conversation with them. And sometimes you have to, I guess, so to speak, you have to be willing to say no. I guess wish that particular seller luck, And sometimes those transactions come back around. I think that's where, from my perspective, we have to be disciplined, how we look at things. No different than we preach to our individual businesses about being disciplined from a project selection and a customer selection. We have to be disciplined from an M&A perspective, and we can't overpay for transactions. We need to pay what's a fair price. And if we're not in alignment about what fair is, sometimes you can bridge that gap with an earnout, so that if the business performs at a higher level, then they get paid and we get paid and everybody feels good about it. But if you feel that in general that you would potentially be overpaying for the business, you have to have discipline and just say, no, we're not going to do that. And we'll keep in touch, and things come back around, we'll have another conversation about it. So I think it's just really being disciplined about it and knowing what you're willing to pay as you move into any sort of a transaction. Obviously, the higher the percentage of their revenue that's coming from service or recurring revenue is going to drive a higher valuation. And businesses that have a larger percentage of their revenue coming from installation work or new construction activity is going to get a lower price. And so if people want to have a higher price, it's like, all right, we'll wait and build up that revenue and in the service piece of your business, and we'll have another conversation about it down the road.
Whether you've learned them the hard way or the easy way, what would you say are your biggest lessons learned to date?
Well, the biggest is culture, values, and fit. The second is don't overpay. The third is that if the seller won't guarantee their work in progress schedule, they're hiding something in their work in progress schedule. The fourth is if the seller won't guarantee their accounts receivable, then there's a problem sitting inside their accounts receivable. Fifth is probably making sure most of these businesses, the building and the facility is a related party transaction, and oftentimes they're paying rents at above market. So do we have, are we paying market rate rents? All that stuff. What are you going to integrate? What are you not going to integrate? Are you going to move them onto your health insurance plans, or are you not? All that stuff has to be communicated right up front, so that there's no questions about where it's going to go when the transaction closes. And I think that if you can do those things, you'll find out that the deal will be successful for both parties on the other side. All of that stuff came from the School of Hard Knocks. Back actually before I came to API Group, we bought a small business in New Orleans. They didn't guarantee the work in progress schedule, and we just got absolutely punished. And it's like, we're not doing a deal unless there's some sort of a guarantee on the work in progress schedule. Now, you do a Chubb Fire and Security transaction, that's going to be a public company transaction, and you're getting what you get. And so you have to, your diligence has to be done at a different level.
It makes total sense. And the first question that popped into my mind is, and you kind of touched on it earlier, but how do you work with the team to avoid deal fever or falling in love with the deal?
That's just discipline. For me, I can honestly look you in the eye and say, I've been doing it for almost 20 years. And you know what? I don't need any headaches. So, let's just make sure that we're being smart about it. Most of the time, there's plenty of signs that come up that, would steer you away from pursuing a transaction. At the end of the day, it comes down to, just being super disciplined about what you're doing. I think, if you're talking about me, sitting in my perch, I think a big part of it is for me to be willing to listen to other people's, thoughts and opinions. And there's probably too many people who think that I probably don't listen enough, including my family. But the reality of it is that if you're not willing to listen, then you're only getting X amount of the fact pattern. And then you might, catch yourself, making a mistake or getting a little overzealous as you pursue, a transaction.
Success begets success. You all have done so many and been at it for so long. There's going to be another one down the road. You don't have to fall in love with this one. You don't have to make this one work. There's going to be other opportunities because you're constantly in the market looking for them.
Yeah, I was talking to the woman who leads M&A for us today. We have like 4 what I would consider mid-sized opportunities that we're We're not dug in on any one of them to any level, but there's we have some interest on these four opportunities. And my conversation to her was we need to pick what's our priorities and put them in a list and just start working down that list, because we're not going to do all four of them. Number one, we wouldn't have the capital to do it, both from an actual capital, but we also don't have the human capital to do all four. And so you have to just, be honest about it, and that's okay.
Absolutely. Absolutely. We've kind of touched on a lot about your philosophy, how you approach it, the things you look for, almost as sort of advice to others out there that are thinking about pursuing an acquisition strategy. I'd love to hear your take on, if you were to give advice for folks considering selling their business, what would that look like in your mind?
Well, I mean, there's a lot there, right? I mean, I could take this part of the conversation in about 17 different directions. I think the most important thing, if you're a seller, you have to ask yourself right up front is, what's important to me? Is finding a good home for the folks on my team, is that a priority for me? Do I want to continue working in the business, or am I looking to, as quickly as I possibly can, transition out of the business? I mean, those are things that are important to us. We're not buying a business where the seller, wants to quit, 6 months later. We're looking for that transition period to go for 2 or 3 years. I mean, we get the fact that people are, want to retire or want to, slowly transition out of their roles. That would be a second thing that I would potentially, consider. The type of structure on the transaction. What is the buyer willing? How is the buyer looking at it? Are they looking at it from a stock perspective? Are they looking at it from an asset perspective? And how does that affect me from a tax perspective? But I think those are really kind of the key things when I'm thinking about more of the traditional API type of transaction. Maybe next I would add in, do I feel comfortable doing this without an advisor? Do I need an advisor? Who would that advisor be? Because, some people are actually good at it and some people are not good at it. And are they going to represent your business and your employees and your team in the right fashion? So I would suggest they call, somebody at API and ask them for their advice. And if they're in the life safety space, we might be interested.
You might know somebody, right?
Yeah, that's exactly.
Well, perfect. I switching gears. Obviously, you mentioned when you went public, things changed, and the way that you look at acquisitions now is a bit different. I think you talked about two lenses, right? One is the transformational lens, i.e., the Chubbs of the world, and then you've got more of the strategic extensions of your existing businesses. But how has life changed for you since going public?
Well, I mean, a lot. I mean, there's just no getting around it. To lead and run a publicly traded company is different than running a privately held company, and it takes different people to really effectively lead a publicly traded company versus private. And we went public, through a SPAC, which is in its own way a form of an IPO. But, we went from private to public, essentially overnight, and went to work building that airplane as it was, running down the runway. And I think it's a different model and a different approach. And the reality of it is, the SPAC and how the business is founded matters. And, we actually have the 3 individuals that founded the vehicle that acquired API. The way they get paid is based on the performance of the company and the share price. And so their incentive is to ride right alongside us and help us be successful, versus the transaction closes, they take a fee and they redeem their shares and run. And so it's worked, really well for us. We didn't have compliance, we weren't worried about being SOX compliant. So, we have a compliance office. And when we were private, I had one shareholder that I had to please. Now I have multiple shareholders that we have to please. And depending upon the time of the quarter, I probably spend 20% of my time, on investor relations, which means I'm not spending that time on our business and in our business. And so we've had to evolve organizationally to make sure that we're maximizing the performance of our individual businesses in the company. So I do think we found the right home for the company. I wouldn't change anything from that perspective. The journey has been crazy, especially when you think about sprinkling the pandemic in there and then all the issues associated with inflation and supply chain and now potentially a recession. The company and our people, to be totally honest with you, I mean, like you think about resilience. I mean, our people have been just absolutely amazing in how they've prioritized the company and put the company first and done everything they can to help the business move forward through a very, very difficult time frame. And couldn't be more grateful for them, thankful for them, proud of them. Yeah, amazing.
I mean, what you just said, I mean, that's a heck of a lot of disruption, external disruption. As you look at API versus other firms that have gone the SPAC route, API has been a bright spot, obviously a significant bright spot among that community of companies. So what do you attribute that to?
Number one, I attribute it to the way Martin Franklin structures his vehicles. I mean, there's a few things that are unique, and I'm by no stretch of the imagination an expert on SPACs, but his vehicles are always established on the London Stock Exchange. It's less expensive, and when they find the transaction that they want to do, they only need board approval. They don't need shareholder approval. So, you think about our situation and the majority shareholder, gentleman by the name of Lee Anderson, and where he was at from an age perspective, he wants certainty. He doesn't want, this whole question of, are the shareholders going to approve it or not going to, approve it? And that's a big deal. And, I think that's pretty meaningful. And then again, I think it's really about how do the founders get paid? Do the founders basically, upon the closing of the transaction, take a fee, redeem their shares and run? Because that's what was happening with these SPACs that were founded on the New York Stock Exchange. And there's a reason that they failed. And I also think that they were not the type of business that they were acquiring. Like, you need to actually have a real business and a real company. And people were selling startups to SPACs and businesses that didn't have products that were approved by the FDA or whatever. And all of a sudden that business could struggle. And so I think that there's just some things that, like I think we fit really well for the vehicle that acquired us. And it's worked out great. So we're one of probably the top 5 or 10%.
Yeah, it's quite impressive when you look at API's performance versus the peer group that's gone the SPAC route. You mentioned 20% given the time frame spent on investor relations. I'm curious, now being public, how do you spend the other 80? If you were to break it down into big chunks.
I mean, a lot of ways I spend it on the same stuff, and a lot of ways I'm spending it on different stuff. I've really re-energized my efforts around culture and our purpose of building great leaders, in making sure that we're keeping that at the forefront of everything that we do. I spend time, in our businesses. Like last week, I visited two of our business locations, one in Tifton, Georgia, one in North Carolina, where I typically do town hall meetings and interact with with the people on our team. I always come away from those visits with impressions and opinions, and usually some things and opportunities that I see that we could potentially fix and make better. But the most important part is being out there with the folks on our team. I think that I bring the most value to our organization when I'm focused on our people, our culture, our purpose, and, their health and well-being, and what's going to move the needle for us over the long haul.
It's interesting, as you talk about that, I'm reminded of a gentleman named Bob Bueller, who was the longtime CEO and chairman of MWH. And he was talking about leadership and where leadership should spend its time. And it was, the 4 levels of leadership. And level 1 was kind of the day-to-day fire drills. This customer's upset, somebody filed a claim. Level 2 is these more 3 to 4 months out. It's more rear view mirror than forward looking, but it's putting together a committee to make sure that level 1 issue doesn't happen again. Level 3 is more 3 to 5 years out, more strategic. Where do we place our bets? What markets? What segments? And level 4 is really the enterprise level. It's the culture, it's the brand, it's the capital structure, it's the bigger picture areas of the business that only the CEO or the top C-level leaders can and should spend their time on. And his point and his punchline was that most leaders barely get out of level 2 just because the nature of the business is such that If you don't have the team around you to lean on, you kind of get pulled down and managed by the organization versus the other way around.
Well, I mean, if you're not with your people, I don't know how you can know what obstacles they're facing, what challenges they're having. You can't run a business based on spreadsheets, at least not a services business like ours. We have 27,000 employees across the world now. And I think it's important for us, as leaders to be visible in the organization. And we do videos and, we've got a lot of things that we're trying to do as an organization to make sure that we are giving people access and they need to see. It was really interesting. I mentioned I was visiting this. We bought this company by the name of Sunland. It was a bolt-on to one of our existing businesses. This is the one that's in North Carolina. And we had a town hall meeting. They brought everybody in from the company. They had men and the women that work in the field and brought in to the office and everything else. And I had an individual ask me a question, and I don't get many questions that stump me. He asked me a question that I thought was so profound, and it was so simple. He asked me, how do I know that you really care?
Wow.
And now you're standing in front of a group of 200 or 250 people, whatever it is, but like, I really care. Like, there's a lot of people that sit in my chair that really don't care. And they look at the people that are actually out doing the work like they're just an asset and just a number. And like, that's not how I look at it. And I suppose a big part of that is my upbringing. I grew up in a mining community in northern Minnesota, and my friends' dads were steel workers and iron workers and pipe fitters. And, I just grew up in that environment. And so I've developed this deep regard for the men and the women that are doing the work in the field and how many challenges. And having somebody ask you that question just really made me think. And I haven't stopped thinking about it actually since last week. And essentially my response was, my actions are going to have to show you that I care in everything that I do, and the words that I choose, what I say, how I spend my time. My actions are going to show you that I really care or not. But I'll drag that around with me for a long, long time, because it was really a meaningful question that I'm actually grateful that he asked.
Well, I'm smiling because, it is a profound question and you touched on it, but have you made any revisions to how you answered it then to how you would answer it today if you were asked the same question?
I don't know that I would answer it any differently, because I think the way I answered it was probably, well, not probably, it's truthful. It's how I feel about it. It's me being honest. It's one of those things. If you try to pat yourself on the back, then you come across as being somebody who's not genuine. Like I view myself, and I hope my teammates at API view me this way, but I view myself as very transparent, kind of straight up type of leader who actually really cares.
When you hear answers that are platitudes or examples, it does kind of tend to turn some folks off versus just the straight up authentic, here's what I think and here's what I feel. But what a question. As we're getting close to the end, at this stage of the game, I'm curious what keeps you up at night, if anything.
Oh, I don't know. My biggest problem probably is when I wake up in the middle of the night and my brain starts working, that I can't, calm it down. I think succession planning is probably an area that, I feel like we have the most work to do, which ultimately leads you to, a conversation about depth of talent. Thinking about my successor, I have to think about it differently, right? Because the chances of that person leading a, $6.5 billion company are pretty small. It's probably going to be 9 billion. And so you have to think differently about, the old Wayne Gretzky line, I'm going to skate to where the puck is going to be.
Right.
And, we need to be thinking about leadership in our company, in our organization, that's 4 or 5, 6 years down the road, and what this company is going to look like when it's 7 billion, 8 billion, 9 billion, 10 billion. And what does that look like? And what sort of talents and people do we have to bring into the organization? I think that's something that I've gotten better at over the course of my career, is being more thoughtful about, for a $6.5 billion company in 2022, what does a $7.5 billion company need to look like? And what are we missing if we're going to be successful at $7.5 billion? And asking those questions and being a little bit more thoughtful about it, is something that I've learned over time. And, I think that our board, has traveled these waters. So they have a really good perspective of that. And they've been very, very helpful in helping to give us really good advice on how do we need to be thinking about these things.
Last question I would just ask you is, if you were to be able to go back in time and go back and visit with your 25-year-old self, what's the one piece of advice you would offer?
Oh, that's a loaded question. Maybe don't take myself so seriously. I think that, just based on my upbringing, and, I had a little bit of, my parents split up when I was, 15, 16 years old. And I think that I've had this part of me that, like, I've got to hustle to prove my worth. And I think I've, maybe taken that a little bit too seriously. Probably could have enjoyed the ride a little bit better along the way. I think that the opportunity for me to get to the same place wouldn't have changed, but the enjoyment factor on the journey may have. So maybe don't take myself so seriously, and focus on having more time to smell the roses along the way.
First, Russ, I appreciate you sharing that, and I'm curious, how do you feel you do on that front these days, being where you are?
Well, it ebbs and flows. You know what I mean? Like, I have a coach. This woman's been very, very good for me and helps me, keep things in perspective. This person's more of a life coach too. It's not just like, it's not a pure business coaching relationship. She's asked me to do some different exercises to bring some perspective about how do I want to look back on my career and my time with my family, and asking my kids, what's the first thing you think of when you think of me as your dad? 10 years ago, I never would have done that, and today, I think I'm much more thoughtful about those things. And the reality of it is I'm not great at it. And, that's clearly a learned skill, but having people around you and having a coach or having a mentor or having somebody that can give you that feedback, I think is something that's, super important. I know for me personally that I would be lost without those folks being kind of in my sphere, if you will.
That's great. Again, I really appreciate it, and I'd love to unpack that some more sometime. But I think we're getting close to the end of our time. But what's the saying? Feedback is a gift, and sounds like you've really embraced that here in the last several years. Russ, listen, I can't thank you enough again. Thank you for your partnership. Thanks for agreeing to do this. It was great to spend time with you again today.
Awesome. Thanks, Scott. Appreciate it. Nice to see you. And anytime.
Take care.
Thank you. See you.
Thank you for listening, and please join us again next month for a conversation with Denise Getman. Denise is a partner in our leadership and organizational development practice at FMI, and she'll be here to talk about our recently released industry talent study and what firms can do to win the talent war.